Hi, everyone, and welcome to the Buffett and Beyond Research Stock of the Week. End of January already, 2026, and we're going over ARISTA Networks, and they are in the telecom equipment business, and they're up 661% in the past 5 years. So, folks, they're doing something right. We're going to find out exactly what. And remember, if you want to have lunch on this beach like Jimmy Buffett used to, then you've got to learn how to invest even better than Warren Buffett does now. All right, let's go over ARISTA. Now, ARISTA Networks, and as I mentioned, in the telecom equipment business, leading supplier of cloud networking solutions, sounds good, for large-scale internet companies, cloud service providers, and data centers for enterprises. Very, very important there. Data centers is the buzzword of the past year and will be for this coming year and maybe the year after. And these solutions include its extensible operating system, EOS, a set of network applications, and its 1040-100 gigabyte Ethernet switches. And folks, I guess some people understand what that is. Now, these products are sold through both a direct sales force and channel partners, and that's pretty important because direct sales force, you've got your own salespeople, but channel partners really gets the word out there to other people you may not have contacted or be able to contact or even know exist out there. So channel partners, very, very important. And it has a strategic partnership with VMware, big company, to enhance the adoption of network virtualization, whatever that means, but they're doing it, and VMware is a very, very popular company, or very, very good company in its own space. Now, ARISTA has approximately 4,400 employees, so it's a big company by some standards, but a small company by other standards, which means it has time to maneuver and to grow. So let's compare ARISTA to the other stocks or the average stock out there in investment land. And we're looking at ARISTA, of course, is in green, and the average stock out there is in blue. So the clean surplus return on equity measures the operating efficiency of a company and allows us to compare to other companies right here, 33.7% versus the average stock of 13.5%. And we liken this to a bank account. Would you rather put your money in a bank that's paying you 13.5% or one that's paying you 33 or almost 34%? Yeah, not much of a question there, is it? Now, the net income for the average stock is about 13%. And you see how this 13% over here correlates with the clean surplus ROE? Pretty important numbers. But for now, let's just look at ARISTA at 39.8% with the average stock at 13%. Folks, this is a big, big difference right in here. And then when we look at revenue, yeah, what's supporting this net income growth? Now, net income is profit. So what is supporting this profit? It's got revenue growth almost 4 times that of the average stock. So they are taking this revenue growth and they have good markups and they have a good product, and therefore they're allowed to mark it up. That's why they can bring this kind of money to the bottom line, or this kind of percentage to the bottom line. That's very, very important there. We like to see this revenue, number one, very, very high, and number two, bringing it to the bottom line. Very, very nice. Now, when we look at their clean surplus return on equity, now remember, to get into our growth portfolio, we want to see a clean surplus ROE of around 20%, or the portfolio should average 20%. So the clean surplus ROE here is 30%. What I want to show you is the 3-year average of the clean surplus ROE, 5-year average, and the 10-year average, and you can see consistency in here, and that's what we love to see. So when we look over at net income and the growth of that net income, we see a steady rise year after year after year. That's very, very, very important. In other words, this company is so consistent in what it's doing and the profit that it's bringing to the bottom line and the growth in that profit that the market knows how to put a value on a company that has a clean surplus return on equity of 30.5% projected for 2026. Very, very nice in there. Retention rate, 100%. That means they're taking all the money they are making, putting it back into themselves in order to grow. And how do we know they're using that for growth and they're using it efficiently? Because we come back to this clean surplus ROE. Remember, the average stock out there has a clean surplus ROE of only 13%. So this is 30% that we're looking at. So yeah, almost 3 times as much. Very, very nice. And years to pay debt, folks, this company has no debt. Absolutely amazing. We love it. And of course, recent dividend is 0 because they're taking all the money, putting it back into themselves in order to grow. It's just like if you have a bank account or a stock account, that you're letting it grow and compound rather than taking money out for lunch every day or dinner every day or something like that. You're letting it grow compounded. And that's what a company that is paying no dividend, retaining 100% of their money and putting it to work efficiently. That's what this company is doing. And being in the telecom equipment, it's a nice addition to our growth portfolio, which we had it in our growth portfolio for a while now, and we're just loving it because we're going to show you some numbers coming up right here. And when we look at the 1 year, black line is the S&P 500, and this blue line is ARISTA. So we're looking at 1 year, and in 1 year, this is, it's hard to read, 38%, while the market is up 13%. So the S&P up 13%, and in 1 year, ARISTA is up 38%. So 1 year means 12 months, the trailing 12 months, including today. And I'm recording this on Wednesday afternoon, and it's a down market, and we can see it reflected in the price of this stock and also the market itself. But look at the difference between these two. Now, for 5 years, we are looking at black lines, the S&P 500, and that is up 82%. And ARISTA is up 661% as of me recording this at the end of January. So we love that. And we have a high up here, and we think this stock with growth of 30%, folks, we're looking at this top over here being broken, and it will be broken this year. It'll be broken probably next month. We're looking forward to that. We looked at this nice bottom put in here, rising bottom, and then all of a sudden it shot right up because earnings came out and they said, wow. And that's exactly it. They wowed the statisticians out there who were saying, well, they're going to return this for earnings, but they beat. And that's why the stock is jumping, as you can see right now. And year to date, yeah, we only have a month in here, a little less than a month, and the S&P is not even at 1%. It's at 0.8%, so less than 1%, and this stock is up over 12%. So we like that very much. I know year to date, it's a very, very short period of time. We shouldn't base anything on it. But we can see that this nice rise in here because the earnings surprised everybody. But when you have growth that is greater than the average stock out there, you're going to outperform the average stock. And that's all there is to it. So out of any index, out of any ETF, out of any mutual fund, if you pick the better performing or the above average stocks in that portfolio and leave the below average stocks for somebody else to buy, well, you're going to outperform them and you're going to outperform that index or ETF or mutual fund. And that's what the clean surplus method is all about, because it allows you to compare and it gives you a number on which to go by, and it's representing the core operations of a company. So folks, we had a pretty up and down week this week. We had a pretty up and down month with the market not doing much of anything in January here. And yeah, we have one more day to go in the trading of January, and we'll just see how it goes. But really, the market has done just about nothing. And we have some ETF portfolios that are doing very well right now, but that's in our ETF newsletter. We'll look at those because if they're all above 10%, you're going to love it. So, folks, you go out, forget about the market. You know why? Because it's going to be open next week, and we'll be here right alongside you. So, folks, take your mind off the market. Be with your family this weekend. Most of all, be safe, and we'll see you right back here in a couple of days.